It has been another record first half year for Morgan Sindall. These results further demonstrate our track record of delivering strong revenue and profit growth, robust cash generation enabling continued investment in our partnership businesses, while importantly supporting strong dividend growth. Our combined secured order book and work at preferred bidder stage grew 24% to 17.8 billion. I want to express my thanks to everyone in all our businesses, our partners, our supply chain, and all our clients who have made these results possible. The diversified nature of our decentralized culture and our empowered teams have enabled us to continue to make our businesses better, and then better again for all our stakeholders. Our strong balance sheet continues to be a very important differentiator in winning work, while also allowing us to make the right decisions for the long term.
Today's results continue to represent our strong track record of delivering growth over the long term, with revenues up 7% to 2.4 billion. Adjusted profit before tax and amortisation up 37% to 95.9 million, supported by an equivalent PBTA margin of 4%. That represents an expansion of 80 basis points when comparing to this time last year. Net cash at the end of the period was 390 million, nearly 40 million ahead. Now, whilst our average daily net cash dipped slightly to 354 million, we have continued to actively invest in our partnership businesses to drive growth for the long term. We've also seen substantial growth to our secured order book, increasing 39% year on year to 12 billion. And that's been followed by almost a further £6 billion of work at preferred bidder stage, bringing our collective total secured order book and preferred bidder work to £17.8 billion. Now, this provides us with an incredibly strong platform to deliver our future revenues over the short, medium and long term. As a result of these strong financial results, we have today announced a 20% increase to our interim dividend, rising to 50p per share. In the period, Partnership Housing has continued to strengthen its long-term partnerships with the public sector, notably through the award of 2 long-term partnerships. The first being with Cardiff and Vale of Glamorgan Council, and the second with Barnet Council. Collectively, for both of these schemes, we expect to build and deliver around 3,500 homes over the next 8 years. Revenues increased steadily for this division by 6% to 405 million, whilst demand for contracting work with the public sector has continued to remain strong, with revenues in this segment increasing by 21% to £311 million. Now, despite this revenue mix profile still being weighted towards contracting, and against the backdrop of a housing market which continues to experience slow recovery, the division has continued to deliver strong profitable growth, with operating profits rising by 13% in the period to 13.2 million. With an order book of 2.2 billion and a further 2.8 billion of work at preferred bidder stage, we've never been more excited and confident about the medium and long-term growth prospects for Partnership Housing. For mixed-use partnerships, the division reported a small loss in the period, noting that this includes investment costs supporting secured schemes yet to start on site and therefore not yet generating a return, as well as supporting those schemes that could present future opportunities for this division. At the same time, the division's continued to build on its prior year successes through the conversion of 5 schemes previously at preferred bidder stage and now assigned development agreements at the end of the period. At the end of the first half, the development order book increased by 150% year on year to 4.6 billion, with almost a further billion at preferred bidder stage. Fit Out delivered another significant and market-leading performance in the first half, with revenues up 33% to 838 million. Operating profit rose by 41% to 58.1 million, once again strongly influenced by exceptional volumes and operational leverage, both factors of which have led to an operating margin of 6.9% in the period. At the end of June, Fit Out finished with a strong order book of 1.4 billion, 19% up on this time last year. In construction, the division has continued with its strong approach to risk management, right from the project selection stage through to operational delivery and finally to project handover. And it's this foundation that's led to the strong growth in profits and the real quality of earnings delivered in the first half. Profits were up 14% to 16.1 million, with an operating margin of 3.1%. The division has also continued with its strong momentum in winning new work, with the secured order book at 1.1 billion and a further 1.4 billion of work at preferred bidder stage, totalling £2.5 billion of work. In infrastructure, our strategy to manage and deliver complex projects with a strong focus and discipline on risk management has continued. Whilst in the period, we've commenced a number of projects which are all going through the early planning and design phases. As a result of this, operating profit has dipped slightly in the period by 7% to 18.4 million, but nonetheless a strong contribution to the group's results. Equally, its operating margin expanded by 10 basis points to 3.8%. Order books remained strong for the division at 1.9 billion, with a further 600 million at preferred bidder stage. And finally, following the conclusion of its business remediation plan in 2024, Property Services has continued to stabilise its business operations, resulting in a modest profit of £500,000 in the first half of this year.
We have continued to make significant strategic and operational progress across the group. Expectations for the group are underpinned by the medium-term fundamentals for Fit Out, which are expected to remain favourable. I am particularly pleased that today we are increasing the medium-term targets for both the Fit Out and Construction divisions. Following 2 profit upgrades this year, we're on track to deliver results for 2025 in line with current expectations.